Canada Pension and Old Age Security, clawbacks, how to avoid them. What about other offsets? What about disability? What about survivorship? We already did a podcast on that, but we had a ton of questions come back, and we're going to try to answer all those questions today. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. Joining me today is always Christina White. Christina, how are you doing today?
Hi, Darren. I am doing great today. How are you doing?
I am doing fantastic. I'm so excited to go back to this topic because it just, that last episode on this went viral, and we had a ton of feedback, and we want to try to answer some of those questions. So if you haven't watched the first show, we'll put a link in the show here to watch the previous episode on CPP OAS Dirty Little Secrets.
Yeah, I love to see people asking questions and learning more about this because it's just so important, right? The education bit on this, I love that people are getting, more active and learning new things and asking questions. Before we jump in though, I do want to remind everybody that if you are listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, make sure you like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right. So Christina, I just want to start because there was a lot of confusion about the different Canada Pension Plan and Old Age Security. So right off the bat, Canada Pension Plan is not a government-funded pension. The government does not actually contribute to your Canada Pension Plan. You contribute to your Canada Pension Plan, and your employer contributes to your Canada Pension Plan. It's a defined benefit pension plan. Defined benefit means we know what we're going to get based upon the number of years who worked in the contributions. It's a fixed benefit based upon input, but not government funded. Now, old age security is the exact opposite. There's no payroll deduction for old age security. You don't pay a nickel into it. You just lived in Canada for 40 years, past the age of 18, prior to age 65, and you get full CPP and a reduction if you've lived in Canada less. But that's no deduction off your pay, pure government giving you that money. So those are really two distinct products. One's ourselves and our employer fund. The second one, pure government benefit.
Yes, thank you for that clarification. I do find sometimes when we have little clips and stuff, you might not hear the full podcast and it might not sound. I know on this one, I also said that these were substantial amounts, which I still stand by. It is substantial, but I completely understand that it is very hard for anybody with inflation. You've heard me talk about inflation and how hard it is going to the grocery store. So I completely understand that these are not huge benefits. But what I do think is substantial is losing this because we don't realize there's a clawback, because we don't do a little bit of tax planning to make sure that we get that full CPP. So my wording on that was substantial, but what I mean by it'd be a substantial loss. We don't want to lose it. That's all. So I wanted to clarify that side as well.
We don't want any losses.
We don't want any losses. We want everybody to do the planning so that they get the full amount, the biggest amount possible from this, right? That's the goal with this whole podcast and sharing this information.
Cool. Okay, so let's go through some of the questions we had from listeners, followers, or YouTube watchers.
Yes, absolutely. So we had a lot of great questions. This one we got was, neither my husband nor I can keep the Canada pension because each make more than $75,000 per year in pension income. Therefore, if we collect the CPP, we have to return it. We do not care about the CPP little secret.
Okay. Good question. And again, this goes back to my intro. Canada Pension Plan is not a government benefit. You are going to receive your Canada Pension Plan regardless of your income. You can be making $10 million a year. You're still going to get your Canada pension that you're eligible for. Now, you'll pay income tax on it like you would a salary or any other income, but you're going to receive your Canada Pension Plan. There's no clawback for Canada Pension Plan. The clawback only applies to old age security, which is the government benefit that you've never contributed to. So just, again, clarify that. Canada pension, you're never going to lose your Canada pension, assuming it's still going to be there and funded. Based upon a clawback, current rules are you're not going to lose it. Who knows what's going to happen in 20 or 30 years. But Canada pension, that's safe. Old age security, that's where the clawback kicks in, depending upon your income.
And I think for a lot of listeners out there and a lot of people out there, it was the first time hearing about this clawback, right? So a lot of people ask, what is the OAS clawback? No one, it's not promoted at the bank, the OAS clawback. What's going to happen there? Darren, will you give a bit of a rundown on the OAS clawback and how that works? I think that'd be helpful.
Sure. So the old age security maximum that you can receive, and at time of publishing this, it'll goes up all the time based upon inflation, is $8,250 a year. So that's, you turn 65, you collect old age security, you're going to get $8,250 a year. You're supposed to 65, they're going to get $8,250 a year. But again, the government's going to look at this and go, well, if you're wealthy, we think you shouldn't get all that, and we'd like you to pay some of it back. So I get a couple of examples here. So if you're making $80,000 a year when you're 65 and you collect your old AS, you get the full OAS. So you get $687 a month. So if you're making $80,000 and you're 65, you're going to get that roughly $687 a month. But if you're making $100,000 a year, instead of $687, it drops to $459. If you go up to like $135,000 of income, your OAS would drop from $687 to $22 a month. And if you make 140 grand, your OAS would be zero. So basically, the more you make, or anything you make over and above that roughly 80, I think it's $86,000, anything above that, for every dollar of income, you're going to pay back 15 cents. And when I say income, what I mean is if I take $1 out of my RSP and I have to pay 42%, let's say I make 100 grand a year and 65, I take $1 out of my RSP, I'm going to pay my 42 or 45% income tax on that dollar, but I'm also going to have to repay 15 cents to my OAS clawback. So it's an effective tax rate of the 42 plus the 15, a 57% tax bracket. They're not actually taxing your RSP. What they're doing, because you had an extra dollar of income, they're going back and deducting your OAS, what you were paid. So that's the clawback. It's not actually coming from your RSP, but it's the equivalent, in our view, of like a 57, 60% tax, because if you're already paying 42 or 45 and then you effectively pay another 15, that's how you get into these huge tax brackets in retirement. Like a 60% tax bracket when you're making 100 grand at 65 seems a little excessive.
Yeah, and I always go back, like the day to start your tax planning is not the day that you retire. And this is a key reason why we want to tax plan from an early age. Like the wealthy do not start tax planning then. They start tax planning on a very young age for this reason. And knowing these things will help you when you're doing that tax planning. So that's awesome. Another question that we got was on the death benefit. So the CPP death benefit and what that is and how that works. So maybe we can provide a bit of clarification on that side of things.
Yeah, the CPP death benefit is another little dirty little secret of Canada Pension Plan, because it's not actually payable to the spouse or the family. It's payable to the estate. So the estate gets paid the $2,500. So everyone in Canada that's on Canada Pension or has Canada Pension, you die, it's $2,500. That goes to the estate. Well, what other taxes or what tax bracket is the estate going to be in? Well, depending upon how much other assets you have, if you have, $500,000, $300,000, $1 million of RSPs, they add that to your income in your terminal tax return. So if you made 50 grand, but you had 500,000 of RSPs, it would be as if you made 550 grand. So, $1 million of RSPs, when you die, your family's going to net about 500 and the government's going to take 500. But that's going to put you in the top tax bracket. So now when you get your Canada Pension death benefit that's payable to the estate's going to be in the highest marginal tax bracket in your province. So 53 and change in Ontario, 54 in Nova Scotia. So of that $2,500 benefit, the government's going to take more than half, 1,338. Okay, so they're going to give it to you, and then they're going to take back more than half, and you're going to net 1,162. So if you're banking on the Canada Pension Plan death benefit to pay for the cost of the funeral, depending upon what the tax rate of the terminal tax return is, you could be looking at $1,100 and change out of that $2,500. The rest going to tax.
Taxes. They keep coming back,
It's
even
almost
when
like
you're dead.
it's almost like tax is your number one wealth destroyer, right? Like, yeah.
Right? I think I've heard that before. And it just keeps, and you know what? The death benefit too, that's tough because people that are dependent on that and are expecting to get 2,500, I think it's very important that they know that when they're trying to do estate planning and funeral planning and those types of things. Because if you're told you're getting 2,500 and you're getting hit with a $2,500 funeral bill and now you have 1,100, that's tough. That's not easy. And we've talked about the typical, a lot of Canadian families are struggling a bit right now with inflation, and you throw that in, it's not nice.
Yeah, now just to clarify too, like if you die and you have no other income and you don't have RSPs, you don't have properties that are going to be taxable, because that's another big one for real estate investors. If you don't have any of that stuff, then you may get the full 2,500 if you're in a 0% tax bracket at death. I don't know many people that are in 0% tax bracket at death, but I just don't want some poor old 90-year-old listening to this thinking that it's going to be fully taxable and she doesn't have any money like that. That Canada pension death benefit in that case, if you're in a 0 or 10% tax bracket, that's all the tax you're going to pay. It's just at death, there's so many things added to your terminal tax return, like second properties, like the value of your business, like RSPs, like RIFs. All these things really, for a lot of people, put them in a high tax bracket for that terminal tax return.
Gotcha. Yes, that's a very good point. I'm glad that you clarified that for sure. Okay, another one that we saw come up a lot when we were talking about CPP and OAS was, what about CPP disability? What is CPP? Like, where does that play into this big picture?
CPP disability. It's depending what year it is. It used to be really hard to get, then it got really easy to get, then it got really hard to get, and I don't think it's fairly easier to get now. But you have to qualify. So basically, if you've paid into CPP and you're under 65 and you become disabled, they're going to pay you a disability benefit. So now it could be mental or physical, but some disability. You're not able to perform your job. You can't do certain daily tasks. Like, again, we won't get into the definition, but you have to be disabled. The average payment is $1,333 of the people that are on disability, but the maximum was $1,538. And the reason why there's a spread there is your disability pension through CPP disability pension is based upon the contributions you made into the CPP. So if you only worked a couple years and you only made a couple contributions and then you become disabled, you're not going to see a very big CPP disability pension. But if you worked your whole life and you've been paying the max in and then you become disabled, you could get up to that 1538 is your overall max. Now, a couple things on offsets there. So let's say let's say you had a survivor CPP. Your spouse died and you were getting their CPP, and then you became disabled. Well, that's one of those dirty little secrets. You're not going to get the disability benefit you probably thought you were going to get, because the overall max when you're disabled, if you're collecting survivor benefit, is that overall disability max of 1538. So if you're already receiving, whatever, 500, 600, 700 for a survivor benefit, and then you become disabled thinking, oh, my CPP is going to kick in and pay me this disability benefit. Well, it will, but only up to the disability max. So again, those people get penalized for having a spouse that passed away and the survivor benefit. The other offset that people always get shocked about, and these are built into almost every disability plan, every group insurance plan too, some individual plans can be different, is it's going to offset any other disability payment you're going to get typically through a group insurance at work. For instance, let's say you become disabled and your employer offers long-term disability and you've been paying into that, and they say, great, you've qualified for this, you get $4,000 a month of disability till you're no longer disabled or you're 65. But then you also qualify for Canada Pension and disability, and they will make you apply for Canada Pension Plan disability. It's in the contract. And let's say your Canada Pension Plan disability is $1,000 a month. You don't get the $4,000 from the disability and the $1,000 from the CPP. Most disability plans will reduce your disability payment to $3,000 and then the top up of the Canada Pension Plan. So typically you're not going to get both. There's some exceptions if you have personal disability plan set up the right way. But that's huge too, because people think, oh, great, well, I get this CPP, right? Well, you do, but you're going to lose it on your disability payment. So again, just to be aware of, and if you think of it, it makes sense, because the reason your disability rate is what it is, what you pay for disability, is a function of claims. So they know a lot of people that become disabled will qualify for CPP disability. So they effectively charge you lower premiums accordingly, because their expectation of payment of claims is reduced, because they know some people will qualify for CPP disability. Now, there's lots of people that qualify for disability at work that don't qualify for CPP disability. And in that case, you'd get, in my example, the full $4,000 a month.
Gotcha. Okay. That I want to remind everybody that we don't make the rules either. So we are we're providing you the information. I know those numbers they are small. It's very hard to live off of. We don't make the rules here. We're just sharing them with you so that you're not caught by surprise when something like that happens. The offset, right? It is important to keep that in mind. Okay. So the disability. Next comment that we had. This was a great comment. A listener made a comment about the government taking July 1st as the start date for the OAS calculation of clawback. Why does that happen on July 1st?
Well, first of all, I'd like that listener to, apply to control and compound, because that was probably one of the smartest comments I've seen in a while. Yeah, it's true. So typically taxes are completed, April, May. So the calculation is kind of done in July. So what happens is people retire and they start collecting this OAS. But if you worked for a good portion of the year before you retired, well, they're going to go back and look at the previous year, but you could get a clawback again the next year, because they're going to go look back and look at your previous year. It's the same with an RSP withdrawal. When if you work till November and retire and you start drawing your RSPs out in November and December, well, that year they're going to look at your total income, and that's probably going to be the highest income you're going to have for the rest of your life, because you've got 10 months of working and then 2 months of RSP. So a lot of people will defer your RSPs till January in that situation. You can do the same thing with your OAS. You can defer it. And there is a form, it's pretty complicated. There is a form that you can fill out to say, my income is going to be less overall in the year, and they may not reduce it. And there's a reconciliation done, at taxes. It'll eventually catch up. But really shocker to some people in that first year, going, what do you mean? I'm retiring on a $20,000, $30,000 pension. How can I be getting an OAS clawback? It's like, well, because when they did the calculation, they were looking at the working year or a partial working year on top of what you collected for the rest of the time. So again, that's where it's important to talk to an advisor that knows what they're talking about and figure it out beforehand so you don't get impacted.
Yeah, absolutely. And they don't have, the reason we're seeing July is because they don't have the information until June or so anyways, right? So that's why July's kicking in. But be very aware that they're looking at the previous year. You're not finding out until July. So, okay, so that was great. I love going through all this information, but the reason that I love going through all this information is to get questions like this. What are the strategies people can follow to avoid the OAS clawback? So the whole reason we do these podcasts is to provide this information so that, you can start thinking about it now and implement some strategies and think about strategies to, save yourself this going forward. So I think we should chat about some of the strategies that we can use to not run into these issues down the road.
Yeah, well, let's talk about the first strategy is something we don't recommend, but unfortunately, a lot of Canadians have done is, don't save any money, spend everything you have, and reach retirement and have no income. Well, you're getting max OAS there. You're actually probably going to get a guaranteed income supplement as well. That's not a great strategy, but there are really effective strategies that you can do. So I talked about deferring your OAS and your Canada Pension Plan. A lot of people don't know you can defer your old age security as well as your Canada Pension Plan. So if I was still working at age 65 and was showing, a fairly good income, I probably wouldn't want to start my CPP or definitely not my OAS until, if I was going to retire at 67, defer it till 67. You're going to have a higher amount then. and then hopefully you'll be in a lower tax bracket when you stop working. Now, the trade-off of that is, well, if you die at 67, you've got no benefit. So, a partial benefit's going to be better, so that better than no benefit whatsoever. So again, it all depends kind of on your circumstances, your health. But if you're have an income of 200 grand and you're 65 years old, you're not getting any OAS. There's, you can apply for it and get a lower amount now, or you can defer it as long as you want. Either way, you're not getting anything. So I would defer it is a big one. And, we talk about maximizing, well, we're going to talk about cash value in a minute, but TFSAs are another great one. When you take income out of your TFSA, that doesn't show up on a tax return. That doesn't increase your taxable income, tax-free. So for those that are still working and younger, look to maximize that TFSA if you want to avoid some of these problems, as opposed to all the money in that taxable RSP account.
Yeah, start looking out at different non-taxable buckets. So the time is to start looking at this now. Putting everything into a taxable environment at retirement is not going to, you'll have no other choice, right? That's all you've got.
Yeah, and there are a bunch of listeners made some really good comments too on income splitting. And income splitting is, again, advantages if you have a partner or spouse. Single people can't take advantage of this, unfortunately, so they get some penalties against them on their Canada pension if they die because they don't have survivors, and then some penalties with no income splitting. But income splitting, basically, when you're 65 years old, you can split your pension income. Okay, you can split pension income anytime, but your Canada pension old age security at 65, any other pension at any time, and any RRSP or RIF income starting at age 65, you can split with your spouse. So let me walk you through a real simple example. Let's say I retire tomorrow and my income in retirement is $100,000 a year. And I have a spouse who has no income whatsoever, zero income. Well, I can basically take my pension, let's say it was a pension, my Canada pension, my old age security, my company pension, and my RIF income, and I can say I want to split that income with my spouse. So now on our tax return, I'll show a $50,000 income. My spouse will show a $50,000 income. Well, that just got me below the OAS clawback, and I avoided the OAS clawback. So again, income splitting is huge. Now, are we going to have income splitting when you're retired? I don't know. Okay, we never had it before. Stephen Harper introduced it. He also introduced some other income splitting things that now have gone away. The next government took those away. We still have that senior income splitting. But income splitting's a huge one. And again, not to beat up RSPs, but there's people maximizing their RSPs every year with no calculation of what that's going to mean for them in retirement. So, a lot of people are going to reach a point where their RSPs get to a point where, you might have to sit down and do the math and say, does it make sense to contribute more just to put myself in a much higher tax bracket with a bunch of clawbacks in retirement, or is there other places I can save my money?
Yeah, you're kind of kicking the problem down the line, the tax deferral problem down the line, and sometimes the unknown is scarier than what's in front of you. So kind of goes back to the TFSA too. It might be time to start looking at alternative places to be saving that are in a non-taxable environment versus, holding everything in one spot and then dealing with the issue when it, explodes. When it explodes later, when it's really bad later. Start looking at it now and start planning for it now. And I think that's a big important part here is the planning side of things. Don't wait until the day you retire to start talking about income splitting, talking about saving in alternative investments and stuff, right? So I'm glad that we're chatting through these, but we still have a couple more. Yeah. What about drawing down RSPs before starting OAS? So this is a strategy that I see used regularly, and I like it. It's a good one.
Yeah, absolutely. So let's say you're 60 years old, you're retired, and you've got Canada pension, or you're going to have Canada pension old age security, but you have a big pension or a big taxable income. Well, one of the strategies is some people will draw down their RSPs. In other words, spend their RSPs in a rapid fashion, either get the balance down, or some people will go and spend all of it before they flip that switch and start their Canada pension and old age security. So depending upon your RSP balance, and again, a good financial planner can walk you through the math on this, is, all right, for the next 10 years, it makes sense for you to drain your RSPs, and then at age 70, you'll get a higher CPP and a higher OAS. Doesn't always work, but again, there's software that we have, we can run that math. So drawing down your RSPs is a good one. And the other one people really don't pay enough attention to is the type of income. Like dividend income is a very desirable income typically, right? Dividend income is taxed at an advantageous way. But the way they calculate dividend income, what they do is there's a 38% gross up. So if you earn $100 in dividend income, they're going to gross it up to $138, and then you're going to get this tax deduction, and you're going to pay less tax than you would on interest income. But that gross up, that 38%, well, that's going to show up in the calculation to calculate your OAS clawback. So that OAS clawback could be affected because you have a lot of dividend income, and then that dividend income is grossed up 38% before they do the calculation on the net tax you pay. So the type of income is important. Interest income is another big one. Wasn't really a concern for the last 15 years. You get a couple $100,000 sitting in a GIC earning 0.05%. Didn't really bump up your income much. But now we see interest rates higher. Some people could have a couple $100,000, $400,000 or $500,000 in a GIC earning 5%. Well, 500,000 times 5% is $25,000 of pure income. Interest income is just added exactly the same to your income like a salary would be. So if you've got 25 grand there, and you've got 40 grand from a pension, and you've got 12, 15 grand from Canada Pension, and you've got your old age security, all of a sudden now you're approaching that clawback area because of the type of income you're getting.
And that comment really goes to show that the accumulation phase while you're growing your assets and stuff is a lot different than when you're spending your assets. So they can be something that seems so great while you're accumulating can not be so great while you're spending. So when you're just looking at something directly in front of you and not thinking out the longer term and how you can switch that over later, it's not good. So, and I do see people get laser focused. I want $1 million and this is the best way to save the money and stuff. And it may not be the best for you long term, right? What's good today might not be great tomorrow, which I think this is kind of showing that. So if you're in that accumulation phase and you're saving, this is the time to, I know it doesn't feel like it, but it's the time to think about, the spending side as well.
Yeah, I think people not planning for an income, instead planning for a number to save for retirement, is one of the biggest planning mistakes people make. Yes. No one cares in retirement how much money you've accumulated. They care what's my income going to be without running out of money for the rest of my life. And if you don't do the proper planning when you're accumulating money, it's going to be very difficult to do the proper planning when you retire and have that income you want, as opposed to a mythical number of that you saved, but then the net income after all the taxes, clawbacks, et cetera, could be a fraction of what you thought it would be.
Yeah, exactly. And I think that kind of goes, what we just talked about goes into the next one with selling and capital gains. So when you sell your assets and you sell, properties in retirement and that type of thing, you might not realize it, but those things are going to impact your OAS as well. If you have a large capital gain, you can easily hit that maximum amount very quickly. You sell a cottage and the plan is to go out and pay it. Then the next month you get a notice saying you're not getting not next month, but July, you get a notice saying you're not going to be getting your OAS anymore. That really changes your spending. So that's also, I don't know if people think about that as much when they're selling, right? Selling
we have so many real estate investors listening, like, you're 70 years old and you sell a couple properties. Well, 50% inclusion on your capital gains is going to be included in your income. That's going to bump it up, and all the clawbacks are going to happen there. So just be careful when you do it. Maybe sell a couple properties in the same year, so you lose your CP or OAS for 1 year. Again, it's not the only thing we're going to consider when we're selling properties. Don't not sell your property for another 20 years because you don't want to lose the OAS.
No, but I bet you, we're hearing more about the vendor mortgages and those types of things where there's those different strategies that people are using, and it's to kind of take those capital gains, or maybe not even take that passive income for the next few years and then spread that capital gain over a couple years. I don't know if it's for everybody, but it's definitely a strategy that you could use that would be able to help with these clawbacks as well, right?
Yeah. And then there's two last strategies, one short, one simple one, and one incredible one. So the younger spouse for your RIF. So when you have to take money out of your RSP when it turns into a RIF at age 71, following year you need to take an income out. There's a chart. The government says you have to take out 5 point whatever percent this year, and 5 point whatever, and 6% the next year, and 7, and it goes up as you age, the amount you're required to take out. So when you take that money out of your RSP in the form of a RIF payment, that is added to your taxable income. So you don't have a choice. You have to take money out of your RIF each year. So you're going to be in a situation where maybe you need to take out more money than you wanted to from your RIF, and that's going to affect all your clawbacks. Well, one of the things you can do is if you have a spouse, you can use your spouse's age for the RIF minimum. And the RIF minimum is based upon age. So if your spouse is younger, like that's 5 or 10 years younger, the amount you're required to take out of your RIF is going to be smaller if you base that upon your spouse's age. So again, not for everyone, but for a lot of people that aren't really looking to spend their RSPs in a certain year or RIF in a certain year, they can use their spouse's income. And then, Christina, probably without question, the best thing you could do to avoid all these clawbacks. And we just talked about old age security. Don't kid yourself. Long-term care in a lot of provinces based upon income. What else? Your long-term care, your health plan in some provinces, either now or in the future, will be income tested. When we say income tested, I think that is going to be a massive trend over the next 30, 40 years. We know the governments need more money. Without question, taxes are going to be up. So how do they collect taxes? Well, they go after people with money. And how in Canada do they look at you to see if you have money? They don't look at your wealth. You can be a billionaire with $1 billion over there. They're not going to look to tax that. They're going to tax your income. So what most Canadians are doing is trying to build up their taxable income in retirement so they pay more tax. I mean, that's effectively, I don't think it's their goal, but that's effectively what they're happening, because when you save only in RSPs and taxable investments, you're basically guaranteeing yourself a large taxable income in retirement. And I think there's going to be a whole host of government benefits that are not going to be rewarded to you or clawed back because of income, because without question, taxes need to go up. So, of course, I'm referring to how do we solve all this? Well, you implement the infinite banking concept into your life a lot earlier while you're in your 30s and 40s and 50s, and you start planning. Because let's talk about cash value life insurance, Christina. If I have $1 million in cash value life insurance, how much does it show up on my tax return?
Zero.
Zero. Oh, okay. If I have $1 million of cash value life insurance and it results in a $2 million death benefit if I die, does that $2 million go on my terminal tax return?
No, again, zero is going to be paid in taxes. That death benefit is going to be tax-free.
If I have a cash value life insurance and I take a properly structured loan, and we can get into that later, but a properly structured loan, am I going to pay tax on that?
No, it's going to be tax-free.
Yeah. So again, we can get into the ACB another day, but effective if it's set up correctly, tax-free loans, tax-free death, tax-free income. So you can start you could have $10 million in cash value life insurance and $5 million in your TFSA, be in a 0% tax bracket and get every government benefit in the world. You know, my goal is to be in a 0% tax bracket in retirement. I don't think it's going to happen, but that, it's a goal to work towards, because everything I do now is planning for how do I reduce my future tax liability, because tax is your number one wealth destroyer. And unless you get a handle on tax now, it's going to be too late for you in retirement. So for those of you that haven't learned about infinite banking, all kinds of resources on Control and Compound. Check out the books, podcast, go back, listen to a bunch of our podcasts. But if you want to avoid clawbacks, if you want to save tax, you need to do the planning now before it's too late. And the first place to start is infinite banking. That's it. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controlandcompound.com, and you can sign up for an education session with one of our wealth coaches.